In 1694, a Scottish merchant walked into the royal palace with a proposal that would quietly reshape human civilization. He wasn't offering military strategy or territorial conquest. He was offering something far more powerful, a way to make government debt permanent. Kings had borrowed money for centuries, but they always repaid or defaulted. This man had figured out how to make the debt last forever and make it profitable for those who held it. 3 centuries later, global debt stands at $315 trillion. Every government on Earth owes money it will never repay, paying interest that flows continuously upward. This isn't an accident or a crisis. It's a system designed deliberately across 4 specific moments by individuals who understood that controlling debt means controlling nations. The answer to how we got here isn't a conspiracy theory. It's documented institutional history. 4 specific innovations created at 4 distinct moments by individuals responding to immediate crises, combined to form a system where sovereign debt became permanent, tradable, infinite, and ultimately inescapable. Understanding these 4 turning points reveals why national debt isn't a problem governments are trying to solve. It's the architecture they're operating within, by design. Before 1694, sovereign borrowing was straightforward and risky for both parties. Monarchs needed funds for wars or expenditures beyond tax revenue. They approached wealthy merchants or noble families, negotiated loans with interest, and either repaid the principal when funds became available or defaulted when they couldn't. Defaults were common. Creditors lost money. The system reset. Debt was episodic, not structural. If you're watching from anywhere in the world, I'd love to know where you're tuning in from and what time it is there. Hit subscribe and drop a comment below. William Paterson changed this fundamental relationship. A Scottish merchant with previous failed ventures, Paterson approached King William III of England in 1691 with a proposal that would alter the nature of sovereign finance. England was at war with France. The royal treasury was depleted. Tax revenue couldn't cover military costs. Traditional lenders refused additional loans because England had defaulted on previous obligations. Paterson proposed organizing a consortium of wealthy merchants to provide £1,200,000, approximately $300 million in modern value. The innovation wasn't the amount, but the structure. The principal would never be repaid. Instead, the government would pay 8% interest annually in perpetuity, funded by tax revenue. To administer this arrangement, Paterson proposed creating a new institution, the Bank of England. Parliament approved the scheme in 1694. The mechanics were revolutionary. The consortium of lenders deposited their gold with the newly chartered Bank of England. The bank lent it to the government. The government committed to paying £96,000 annually in interest, backed by parliamentary taxation authority. The bank distributed this interest to the original lenders. Crucially, the bank issued notes representing ownership shares in this permanent income stream. These notes could be traded, sold, or used as collateral. They functioned as currency, better than currency because they generated yield. This was the template that would dominate sovereign finance for 3 centuries. Government borrows principal once, debt becomes permanent. Interest flows continuously from taxpayers to creditors. The debt itself transforms into a tradable asset that functions as money. The government gains immediate capital. Lenders receive perpetual income. Nobody expects principal repayment. Within 50 years, every major European power adopted variations of this model. France established the Banque Générale in 1716. The Netherlands formalized existing banking practices around permanent sovereign debt. By 1790, the newly independent United States explicitly copied the British system. Alexander Hamilton, as first Secretary of the Treasury, modeled American finance on the Bank of England. Federal debt assumed as permanent obligation, interest paid from taxation, bonds traded as financial instruments. Paterson died in 1719 without accumulating significant personal wealth, despite founding the Bank of England. But his innovation persists. The Bank of England still operates. British sovereign debt has never been eliminated, only refinanced, rolled over, and expanded across 3 centuries. The first cornerstone of the debt system was laid. Government borrowing became a permanent feature rather than a temporary expediency. By the early 1800s, European governments routinely borrowed for wars, infrastructure, and operating budgets. But the market remained fragmented. Each loan required individual negotiation. Interest rates varied widely depending on perceived risk and available capital. Only the wealthiest merchants could participate as creditors. There was no organized secondary market where existing debt could be easily bought and sold. Nathan Mayer Rothschild transformed this landscape. The Rothschild family had established banking operations in 5 European capitals by 1800: London, Paris, Frankfurt, Vienna, and Naples. This multinational network allowed them to move capital across borders faster than competitors and gave them unmatched information access. During the Napoleonic Wars, Nathan Rothschild in London arranged financing for the British government. His innovation was creating a liquid secondary market for sovereign bonds. Rather than lending directly to governments and holding debt until maturity, Rothschild purchased government bonds at negotiated prices and immediately resold them to institutional investors, insurance companies, pension funds, and wealthy individuals at a markup. He profited from the spread while governments received cash immediately and investors acquired tradable assets. The famous incident at Waterloo in 1815 illustrates the information advantage this network provided. Rothschild's private courier system learned of Napoleon's defeat before official channels reached London. According to widely reported accounts, though details remain disputed by historians, Nathan Rothschild initially sold British government bonds, signaling pessimism about the war's outcome. Other traders, assuming Rothschild possessed superior information, sold as well. Prices collapsed. Rothschild then purchased vast quantities at depressed prices. When official news of British victory arrived the following day, bond prices surged. The profit was substantial. Whether or not specific details of the Waterloo story are accurate, the broader pattern is documented. The Rothschilds dominated European sovereign debt markets by the 1820s because they controlled both issuance and secondary trading. If a government needed to borrow, they worked through Rothschild banks because those banks controlled the investor networks with capital to deploy. The critical consequence wasn't just Rothschild profit. It was how this international trading network made sovereign debt inescapable. Before liquid secondary markets, if a monarch defaulted, specific identifiable creditors lost money. The damage was contained. But once Rothschild made sovereign bonds freely tradable across borders, ownership became diffused and complex. A British bond might be owned by French investors who used it as collateral for German bank loans, backing investments in Austrian railways. The web of interconnected obligations meant that default by one sovereign threatened cascading failures across the entire European financial system. This was the second cornerstone. Debt became so internationally interconnected that default shifted from being an embarrassment to one's creditors to threatening systemic financial collapse. Governments were trapped not by single lenders, but by the architecture of global finance. They had to maintain payments because the alternative was destabilizing the entire system. The Rothschild family's wealth peaked in the mid-1800s. They were arguably the wealthiest family in the world, and that fortune derived overwhelmingly from interest on sovereign debt across multiple nations. They produced no goods, built no factories, invented no technologies. They intermediated the relationship between governments and capital, collecting fees and interest perpetually. By 1900, the United States had become an economic powerhouse, but its financial system remained decentralized and vulnerable to periodic crises. Banks operated independently with limited coordination. In 1907, a financial panic threatened to collapse the banking system. Stock prices crashed, banks failed, credit froze. J. P. Morgan, at 70 years old, personally orchestrated a private sector rescue. He assembled New York's major bankers in his library, locked the doors, and compelled them to pledge their own capital to stabilize failing institutions. The panic subsided. Morgan had functioned as an informal central bank. But he understood this couldn't be repeated. He was aging, and the economy needed institutional mechanisms rather than relying on individual financiers. Between 1910 and 1913, Morgan's associates designed what would become the Federal Reserve System. In November 1910, Senator Nelson Aldrich and representatives from major banks met secretly at Jekyll Island, Georgia. For 9 days, they drafted the framework for America's central banking system. The secrecy was deliberate. Public knowledge that private bankers were designing the nation's monetary system would have triggered fierce opposition. The resulting proposal was politically crafted to obscure banker control. It wouldn't be called a central bank. The term was politically toxic. Instead, it would be the Federal Reserve System, appearing decentralized with 12 regional banks. Governance would include presidentially appointed board members, giving an appearance of government oversight. But the structure ensured banking industry control. Regional Federal Reserve banks were privately owned by member banks. Those member banks elected directors. The most critical power, conducting open market operations and purchasing government securities, was concentrated in the Federal Reserve Bank of New York, controlled by Wall Street institutions. The Federal Reserve Act passed Congress in December 1913, largely because most legislators didn't fully understand its implications. Morgan died in March 1913, months before the Federal Reserve began operations, but his legacy was the institutional mechanism that enabled unlimited government borrowing. The third cornerstone was now in place, a central bank with the authority to create money by purchasing government bonds. Before the Federal Reserve, government borrowing was constrained by available private capital. Banks and investors had finite resources to lend. The Federal Reserve eliminated this constraint. It could purchase government bonds by creating money, providing unlimited demand for sovereign debt. The government issues bonds. The Fed buys them with newly created reserves. The government spends the money. The debt appears on the Fed's balance sheet, backed by the government's commitment to pay interest funded by future taxation. This mechanism made infinite debt possible. The government never needs to stop borrowing because demand for its bonds is guaranteed. Debt can be rolled over perpetually because the Federal Reserve ensures there's always a buyer. By the 1970s, the system functioned globally. Developed nations borrowed continuously, rolled over maturing debt, and paid interest. But developing nations faced a different situation. Many borrowed heavily during the 1970s when interest rates were low and commodity prices were high, financing infrastructure and industrialization projects. Then, the variables changed catastrophically. Paul Volcker became Federal Reserve Chairman in August 1979. Facing inflation exceeding 10% and eroding confidence in the dollar, Volcker raised interest rates dramatically. The federal funds rate climbed from 11% to 20% by 1981, the highest in American history. This crushed domestic inflation, but it devastated developing nations holding dollar-denominated debt. Mexico owed $80 billion. Brazil owed $60 billion. Argentina owed $40 billion. These loans carried floating interest rates tied to U.S. rates. When Volcker raised rates, debt service costs tripled. Interest payments alone exceeded many countries' export earnings. In August 1982, Mexico announced it couldn't make scheduled payments, a default that threatened the entire international banking system. American banks, Citibank, Bank of America, Chase Manhattan, had issued most of this debt. Mexican default meant massive losses, potentially triggering bank failures and systemic collapse. Volcker faced a choice: allow market discipline, let banks absorb losses, and permit the system to clear through defaults, or intervene to maintain the debt structure. He chose intervention through the International Monetary Fund. The IMF provided Mexico, Brazil, Argentina, and other debtor nations with emergency loans, not to reduce their debt, but to keep making interest payments to American and European banks. These structural adjustment loans came with stringent conditions. Governments had to cut public spending, privatize state enterprises, open markets to foreign investment, devalue currencies, and effectively surrender economic sovereignty in exchange for enough money to avoid default. The fourth cornerstone was complete. When debt becomes unpayable, the solution isn't forgiveness or default, but restructuring. Lend just enough to maintain interest flows while extracting political and economic concessions. The debt isn't eliminated, it's made permanent through continuous refinancing. This pattern has repeated for 40 years. Greece in 2010, Argentina multiple times, Sri Lanka in 2022. The mechanism remains identical. IMF loans prevent default, austerity is imposed, sovereignty is compromised, and debt persists. Volcker died in 2019. His legacy is the mechanism ensuring the debt trap operates globally without exits. Even nations that mathematically cannot repay are refinanced rather than allowed to default, because default would threaten the entire interconnected system. There's a common assumption that government debt represents money borrowed from external creditors who could theoretically demand repayment. This is fundamentally inaccurate. Most sovereign debt is held domestically by institutions, pension funds, insurance companies, mutual funds, and central banks that need government bonds as safe assets for their portfolios. Consider U.S. debt specifically. Of roughly $38 trillion in total federal debt, approximately $28 trillion is held by the public, meaning non-governmental entities. But the public isn't foreign powers holding IOUs. It's predominantly American institutions, pension funds managing retirement savings, insurance companies backing policies, mutual funds diversifying portfolios, and the Federal Reserve itself. These institutions purchase treasury bonds because they're considered the safest available assets, backed by the government's taxation authority. The interest on this debt, currently exceeding $1 trillion annually, comes from tax revenue. So the flow is taxpayers send money to government through taxation. Government sends it to bondholders as interest. Bondholders are institutions largely owned by or managing money for wealthy individuals and entities. It's a continuous transfer from labor to capital, operating in perpetuity. The remaining debt is held by government trust funds, Social Security and Medicare primarily. The government borrowed from these programs and spent the money on general operations. Eventually, when these programs need to redeem bonds, the government must either raise taxes, cut other spending, or borrow more. It's circular accounting, but the interest still flows. Scale this globally. Japan holds $9 trillion in sovereign debt, mostly domestically owned. European nations collectively hold $14 trillion. China has substantial domestic debt held by state banks. Every developed nation operates the same system, and they're interconnected. Japan holds U.S. treasuries, the U.S. holds European bonds through international institutions. Europe holds developing nation debt through the World Bank. It's a circular web where everyone owes everyone, and the interest flows upward to institutions managing the assets. The system cannot be dismantled without catastrophic consequences. If the United States attempted to pay off its $38 trillion in debt, the money supply would collapse. Dollars are created when the government borrows, Federal Reserve purchases of treasury bonds create bank reserves that become currency. Eliminating the debt would eliminate those dollars, causing severe deflation and economic contraction. The same logic applies globally. If every government eliminated its debt simultaneously, the money supply would shrink by 2/3, making international trade impossible. So debt cannot be eliminated. It's structural, necessary by design, and the institutions holding the debt, BlackRock, Vanguard, State Street managing tens of trillions in assets, collect the interest. That $1 trillion annually in U.S. interest payments alone, plus comparable amounts from Japan, Europe, and other sovereigns, flows continuously from taxpayers to bondholders. It's presented as debt service rather than taxation, but the mechanism is identical. Workers pay, institutions collect, and the principal never decreases. The four architects, Patterson, Rothschild, Morgan, and Volcker, didn't coordinate across 3 centuries. They each solved immediate problems in ways that benefited financial institutions, but each solution built upon previous ones. Patterson made debt permanent in 1694. Rothschild made it globally interconnected by 1815. Morgan made it infinite in 1913. Volcker made it inescapable in 1982. Together, they constructed a system where governments borrow perpetually, pay interest eternally, and never repay principal. This returns to our opening questions. Global debt exceeds $300 trillion. To whom is it owed? It's owed to institutions holding the bonds, collecting interest funded by taxation. Why does debt never decrease? Because money itself is created through the borrowing process, and eliminating debt would eliminate money. Why do governments borrow continuously? Because the Federal Reserve and equivalent central banks provide unlimited demand for sovereign bonds, making perpetual refinancing possible. The system isn't malfunctioning. $38 trillion in U.S. Debt isn't a crisis for those who designed and benefit from the architecture. Every dollar of debt is an asset on institutional balance sheets, generating interest income. As long as confidence persists, as long as people believe governments will continue paying interest even without repaying principal, the system functions exactly as designed. The debt trap is complete. 4 innovations across 3 centuries constructed an architecture where sovereign borrowing became permanent, interconnected, infinite, and inescapable. Everyone operates within it now, not because of conspiracy, but because each innovation solved an immediate problem in a way that served financial institutions, and those solutions accumulated into the system we inhabit. If understanding these 4 turning points changed how you perceive government debt and sovereign finance, I'd appreciate it if you subscribed. The architecture of power often operates through institutional mechanisms that appear technical and boring, but determine who pays and who collects across generations.